Hi, how's it going everyone? My name is Hank and welcome back to the channel. So today I want to talk a little bit about Girls That Invest. Now, they are one of the biggest investing podcasts in New Zealand, and I am really interested in finding out how they actually initially started in the first place and what they did to get money in the first place and how they become so successful. So I decided to look into several articles to see how they started in the first place. And what I actually found isn't really what I expected. And there was just a lot of things that just don't seem to add up for me. And this is what I'm going to talk about today. So as you may or may not know, Girls That Invest is run by Simmerin and Sonia. And they have a very successful media brand. Now in this article, it says that a young woman 25 grew her net worth from $8,000 to a massive $900,000 within 2 years. 2 years. That is an absolutely astounding amount of return, and I'm really interested in how she actually did that in the first place. In an article from Auckland University said that Simmerin was an optometry graduate, and it says here that she began working as an optometrist 2 years ago before the lockdown and everything had her stuck at home in 2020. So just a few months into her career. So essentially, she pretty much lost her main job around the lockdown period. But here it says that in 2020, Simmerin boosted her savings by taking on side hustles to supplement her income. And she managed to save $57,000 in 1 year to purchase her first home worth $565,000 with a 10% deposit. Essentially, she pretty much lost her main job, and through just side hustles, managed to save more than $57,000. And that is just incredible, like absolutely incredible within just the first year. But here's one of the things that I don't really understand. Now, in their podcasts, they quite often preach the importance of investing into ETFs and index funds. Now, there's absolutely nothing wrong with using ETFs and index funds as an investing vehicle, but that cannot be the way that she got her money from, because the maths just don't add up. If we look at the charts for the S&P 500, if you invest in an index fund or ETF, and assuming that you are getting around an 8% return from the stock market, which is quite conservative but pretty reasonable, you need around 9-10 years before you're actually able to double your investment. So what she's really saying is that she made $1 million within 2-3 years while there's a lockdown pandemic going on, while she doesn't really have her main job to go with. And she's saying that she did that through the stock market. And the math just does not add up there. There's got to be something else going on. So here we have a chart of Simmerin's net worth broken down. So it says here for her home, it's worth $720,000. But just in the article just like above, it says that she bought a house that's worth $565,000. So where does this sudden increase come from? Hey, I don't really know. $4,000 from KiwiSaver, fair enough. Shares, okay, $50,000. Not exactly sure where the shares, the value of the shares is coming from, but okay, let's give it that. But here, business bank account, $630,000. Now, unless I'm very, very mistaken, you can't just say that the business bank account is the same equivalent as your own net worth. This is pretty much like saying if you are the CEO of Apple and Apple is $1 trillion company and suddenly your net worth is $1 trillion because you're the CEO of Apple. Like legally your business and your personal net worth should be separate entities. So you can't really use your business net worth to account for your personal net worth. So essentially the 630 doesn't really count for calculation of personal net worth. So we have $13,000 in terms of savings. Okay, cool. That's no worries. Value of businesses. Again, you can't use the value of businesses to count for personal net worth. This just doesn't really make any sense at all. And the next thing, cars, boats, caravan. Okay, fair enough. Liabilities, mortgage, $500,000 worth of mortgage, plus around $40,000 worth of student loan. If we actually did some actual calculation using a calculator, and let's say she's got her house worth of $565,000, plus $4,000 KiwiSaver, plus $50,000 in terms of shares. You can't use the business bank account to account for personal net worth, so that doesn't count. $13,000 of savings. You can't use the value of businesses. And then you add in the $26,000 in terms of car. So you end up with around $650,000 of assets. And then you minus around $500,000 worth of mortgage. And then you minus around $40,000 in terms of student loans. So you'll get around over $100,000 in terms of net worth, which is, again, it's pretty good, but it's nowhere near the millionaire status within the 2 years that the article is claiming. It also says here in the article that she mainly invested in exchange-traded funds ETFs, including the S&P 500, but also invested in specific companies such as Tesla, Shopify, Apple, Amazon, and Google. And here is said that Tesla gave me a 400% return on her money. Now, this is an extremely unlikely situation for most people. Most of the times, shares do not return 400%. So she invested $14,000 in the share market and gained a profit of $4,000 over the year. And again, this is an extreme situation that is brought about by the huge market spike after all of the lockdown. And this is just not something that's that usual to see. It's just like people that bought houses around the lockdown time where everyone was buying houses and then they sold off the property at a huge margin. That is not really a sustainable way to get money. In addition to that, she had personal savings of $28,000 and around $9,000 in her KiwiSaver account. So where does this $8,000 initially come from? Down in the comments, it even said, so much information missing from this article. First, how does one save $57,000 in a year? Second, let's see an asset and liabilities table when she first got started so we can compare. I suspect her starting net worth was not actually $8,000. And where did the $630,000 in her business account come from? These are very, very good questions that remain unanswered in this article that's basically saying how she just became a millionaire, pretty much straight away after investing some shares in some companies and doing some side hustles on the side. I guess this is one of the things that you have to pay attention when you listen to people talk about financial education. Now, girls that invest, they have built a brand. They have built a media business around giving financial education, and they even sell courses that talks about financial education. They are generating their income through the business, and they're funneling the income that's generated from the business into other investments, such as real estate, such as stocks, and in turn, those things can give them additional compound interest over time. You have to realize that this is very different from preaching the idea of you or I putting a bunch of money, like a couple $100 or even $1,000 every month into an index fund, into an ETF. Index funds and ETFs are good financial vehicles and can make you wealthy over the long term. They take an enormous amount of time for compound interest to work. So by doing things that way, you pretty much have to go for 20, 30 years before you actually reach that status of becoming, like a millionaire. And by that time, you're probably around retirement time anyway, and there's probably not enough time for you to enjoy the money that you earned. And this is very different from what they're doing. They're building a brand. They're building a media, plan. They have a business going on that's generating them profit. You have to realize that they are basically selling you something different from what they are telling you to do. They are not telling you to start up a business yourself. They're not telling you to start up a media business. They are not telling you to start up a service or sell a product. They're basically saying that if you invest in index funds, if you invest in ETFs, and after 30, 40 years, you can retire with some money. This is not the same thing as they're doing. And this is not the same thing as many of the financial gurus are doing themselves. Many of the financial gurus, they are building a business. They are building a brand. They are building something that can generate themselves a lot of income from a lot of different people. Now, this is by no means saying that you cannot build wealth, over time. But again, you have to realize the difference here. The difference is one thing takes a long period of time, and the other thing is building a business, building a brand. And that generates a significantly more amount of income within a much shorter period of time. And this is something that you have to realize the difference. So if you ever listen to any financial educators, think about what they are saying and what they're actually doing themselves. Are they running a business, or are they doing the same thing, going to a 9-to-5 job and putting the money into an index fund? And then you'll see the difference. You'll see the difference of how people are actually making money.